Good morning, everyone. Last class we finished deferred taxes, right? So today we will start with another unit of R7, that is lessee accounting. Earlier in your curriculum, if you see the old syllabus, old curriculum, so in that old curriculum, accounting of both lessee and lessor were tested, but as per the new curriculum, the lesser accounting has been shifted to bar, right? So here we have to do only accounting for uh, lessee, right? Now, before going into the accounting for lessee, I would like to make you aware of the certain terms like what are leases, right? This is important to note, that what do you mean by lease, right? Now, basically, it's a contract between two parties, wherein one party is known as the lessor and other party is known as the lessee. The lessor has a property, plant and equipment, PPE. The lessor gives the right of use to the other party, which is known as lessee. Basically, it's a sort of rental agreement, right? So normally, whenever I take a place on a rental basis, the amount of rent which I pay is usually an expense for me, right? But here, depending upon certain criterias, right, we are going to classify lease, right? So what is a lease contract? What is a lease contract, right? Basically, it's a contract between lessor. Basically, he is the supplier and the lessee, he is known as customer, right? It's a contract between lessor and lessee, right? Now, what's the contract is all about? The lessee has the right to control the use of identified, right, lessor's PPE for a period of time in exchange for consideration. The lessee has the right to control the use of identified suppliers PPE for a period of time in exchange for consideration. Right? It means whatever economic benefit I am going to derive from this asset, it will purely belong to the lessee. This rental agreement is arranged in such a way that you give me this asset, now forget it. By using this asset, whatever benefit will derive, I will derive, that solely belongs to me. You don't have any right on that, right, for that lease period, right? The lessee obtains substantially all of the economic benefits from use of the identified asset. Right? Now it is okay that I am giving you a part of my benefit, like a certain percentage of my earnings I will give it to you. That is okay. Or a certain percentage of sales I will give it to you. But you use 50% of the asset and I will use 50% of the asset, not possible. The consideration can be in any way. The consideration can be based on lessee's performance. The consideration can be based on lessee's sales. But all the economic benefits belongs to me. Whatever sales I am making by using your asset, certain percentage I can go. That is okay. Right? Lessee pays a portion of these benefits to the lessor. It is okay. No problem. Right? Now there might be some operating limitations that has been imposed on me, that you need to use this asset in this way, because after this time period is over, this asset will go back to the lessor. Right? Suppose I have taken your equipment on use and I am using it in a manner that it will cause major damage to the property, so that he won't allow. Right? So he might put some directions, right, on the basis of that. Right? I'll give you the asset for use, but these are certain directives that you have to follow. That is okay, no problem. Right? So right to direct the use of the identified asset, it is okay. Right? Not okay if lessor has substantive substitution rights. Now if I am substituting asset, that today I am going to give you this asset, tomorrow I am going to give you this asset, then it is not a lease contract, because the asset needs to be identified and that asset will remain with me throughout the lease term. Like in rental business it happens. Today I am sending you this car, tomorrow I am sending you this car, day after tomorrow I am sending you another car. No. So not okay if lessor has substantive substitution rights. And generally this is beneficial to lessor. Beneficial to lessor. Right? So these are certain points which I want to tell you regarding the lease contract, right? Now we will talk about the lease classification, right? If I talk about now lease classification, this is very important. Now, suppose if I have taken 5-6 PPE on a lease contract, right? So in that case, I need to do it for each lease component. It's not like that. Okay, if I follow this accounting treatment for one, that applies to all. No. So when you do lease classification, we need to do it for each separate lease contract, for each separate lease contract, right? And we are going to do it at the inception date, at the commencement date, and once it is final, every year we follow the same classification until and unless the contract is modified, right? So this we are going to do it for each lease contract, right? Now, if I talk about lessee, there are different classifications for lessor and lessee both. If I talk about lessee, now suppose an asset useful life is 5 years, right? Suppose an asset's useful life is 5 years, okay? An asset's useful life is 5 years, and I, being the lessor, has given this asset on a lease term of 5 years. Now tell me one thing, after 5 years, is this asset useful for lessor? Absolutely no, because it is covering the major portion of the useful life of the asset. So in these type of lease contract, right, in these type of lease contract, basically lessee is the owner by default. Basically lessee is the owner in these type of contract. Lessee itself is the owner. So there are some criterias. If that criteria is met, then these are not my rental expenses. These are my assets. And every year I will give depreciation on that. Are you getting my point? Right? So if I talk about lessee, basically they have two types of lease. One is finance lease. If any of the owner criteria is met. If any of the owner criteria is met. Operating lease, normal rentals, right? Now this lesser is not there in our syllabus, but still I am going to show you. There are three classifications for lesser. One is sales type lease, other is direct financing lease, then we have operating lease. right? We have sales type lease, direct financing lease, and then we have operating lease. Right? So this particular lesser classification, there are three types, right? It is not there in our FAR syllabus. It will be covered in bar, right? But what is important is for our syllabus is lessee, right? Finance lease and operating lease. In finance lease, I am the deemed owner, basically. I have taken it on rental basis, but still I will be regarded as deemed owner. Simple. Substance over form. On paper, lesser is the owner. But if you see the substance, who is deriving the majority usage of the asset? If the asset useful life is say 20 years, say for example, an asset useful life is 20 years, and I have taken it on a lease term of say 5 years. So this does not cover the major portion of the useful life of the asset. After the asset term, after the lease term is over, the lessor can give it to someone else, right? But when the asset useful life is 5 years and 5 years is the lease term, then I am using the full asset. Even if after the lessor gets back the asset, he is only going to scrap it, nothing else he can do, right? Now let me talk about some more terms, and one more term is lease term. This is very simple. This is non cancelable period for which a lessee has the right to use, right? Together with optional periods. There are some optional periods, right? Now, what are those optional periods? There is an extension, and the person is reasonably certain that he will exercise that option. So that particular time period will also be included in lease term, right? Option to extend the lease if the lessee is reasonably certain to exercise that option. The number B. Option 2, terminate the lease if the lessee is reasonably certain not to exercise the option. Means he will use the full lease term. right? Option 2, extend, not to terminate the lease if the option is controlled by lesser. Is it okay? Right? So today we will just build up the concepts, right? Because it is very necessary when we do accounting for lease contracts. So these things are very important, that who is a lessor, who is the lessee, uh, the inception date, right? The lease term, the lease payments, right? We will next topic we are going to talk about the lease payment, basically the rentals, right? So payments made by lessee to lessor, right? Payment based by lessee to lessor relating to use of the identified asset, right? Asset means identified asset, right? Now, whenever I am talking about lease payments, remember one thing. Suppose the lease term is 5 years and every year I will pay you 1 lakh each, right? So what I will do, when I record these lease payments, I will record it as a liability at the inception date, the present value, right? I will record it as a liability on the inception date. Only if the lease term is 12 months or less, then in that case I'm not going to use the present value concept. Then every month when whatever I pay, I will record it as an expense, right? So you need to note one thing, whether it be finance lease or whether it be operating lease, right? Under both the cases, lessee, right? When I talk about this, lessee is required to recognize a lease liability on its balance sheet at the rate present value of lease payments, right? So this is very important. Whether it is operating lease or whether it is finance lease, it does not matter. Yeah, just like taking a loan, whether operating lease or finance lease. Right, slowly you will get into the concept, right? Now, what do lease payments include? Right, lease payments include the following. This is very important. If I don't know what will be included, then how will I take the present value of those payments, right? So it is quite simple that whatever rentals I am going to make, that will be included, right? It is known as fixed lease payment. So number A, we have fixed lease payments. Right, deduct lease incentives, right? That is payment made by lessor to the lessee, right? Now, fixed lease payments. Fixed lease payment means minimum payment that I have to make, right? Like suppose you are going to give me 5% royalty and a minimum of 1 lakh. So that doesn't mean this is variable payment. It's a fixed payment only, right? So the substance has to be fixed. Is it okay? Further, any payment that has been made by the lessor to the lessee or on behalf of the lessee, so that will be subtracted, right? So these things you need to note, right? This is very important. There are some optional payments. We have some optional payments. There are some optional payments that we are supposed to make. What are those optionals? Remember, if I extend the lease term and the lessee is reasonably certain to extend, sometimes they might give you purchase option. Okay, after suppose the useful life is 5 years, and the lease term is 3 years, and I'm giving you some option to purchase after 3 years, and the lessee is reasonably certain to exercise that option, so that purchase price is also optional payment, right? So optional payments can be related to optional period. If the lessee is reasonably certain to exercise the extension option, optional period to extend, or optional payments to purchase. So these will be included in lease payments, right? Then we have residual value guarantee. This much I will give you at the end. Right? So fixed lease payment has to be in substance fixed. It can be option of two, like minimum this much and based on performance. Optional payments, residual value guarantee, all these things, right? So this is the scrap value I am guaranteeing. So all these things will be included in my lease payments. Now lease payments lease payments do not include variable lease payments do not include variable lease payments that are based on the usage or performance of the asset, right? Any other guarantee which the lessor is giving, that also will not be included. Residual value guarantee is okay, but any other guarantee which the lessee is giving, that is not included. Other guarantees, right? Is it okay? I guess things are very clear now. Okay. Now there is one concept of discount rate. right? Like I told you that we have to calculate the present value of, remember, lease payments and recognizes that as a liability, right? So this is the rate at which the lessee discounts the lease payment and recognizes it as a liability, right? So next is discount rate used by lessee to calculate and amortize the lease liability, that is at the rate present value of lease payments, right? So what is the discount rate? Generally it is the implicit rate of the lease contract, right? So this is like use the implicit rate in the lease if readily determinable. Otherwise use lessee's incremental borrowing rate. This is the similar rate at which I have can borrow other finance. Similar sort of, right? So I will make you understand how to get this implicit rate also. This I will explain you. This implicit rate is generally calculated by the lessor, right? This is implicit rate in the lease. So like in finance you might have learned IRR, where you equal the inflow and the outflow and you get the rate. So basically implicit rate is that rate only, right? This implicit rate is calculated from lessor point of view, and it is used by the lessee to calculate and amortize the lease liability. So if this is not available, then you can use lessee's incremental borrowing rate, right? So as of now, if you can see, uh, we have covered quite a few terms. So now we are properly geared up to start our discussion. Okay. So first we will be going with operating lease, and then we will be going with finance lease. Okay. And whatever treatment I'm going to teach you in this particular FAR is for lessee. In bar we will go for lesser, right? So it's a contract between the lessor and the lessee, right? Supplier and the customer. It's a right of using the asset, right? Substantially all the benefits should flow to me, and I can give you some part of the remuneration, right, as a percentage of sales, but I cannot give you some part of the asset to use, right? Substitution right, not okay, this is not a lease contract. Then classification is either finance lease or an operating lease, right? And then we spoke about the lease term during which the asset is given for use. It includes the optional extension, which I'm reasonably certain to exercise, right? And option to terminate if the lessee is not reasonably certain, right? Not to exercise. Otherwise, the lease term will end early, right? Then we have talked about lease payments, which includes fixed payments, right? Optional payments also, and residual guarantee, right? Do not include variable lease payments or any other guarantee given by the lessee, right? And the discount rate is generally the interest rate. So use the implicit rate in the lease or lessee's incremental borrowing rate, right? Having done this, it's our time to go for operating lease, right? So we are starting lessee's accounting, right? So now we'll be talking about operating lease. This is other than financially. It means that criteria is not fulfilled, right? There are 5 criterias. Any of those criteria is not fulfilled, right? So now we will talk about operating. So whether it be operating lease or whether it be finance lease, anyway we are going to show our present value of payment as liability, right? What are we going to do? We are going to show present value of uh, lease payment as liability. So at commencement date, when the lease term commences, so at commencement date, what I will do, capitalize as right of use asset on balance sheet and corresponding lease liability, right? I'm not showing it as an asset, right of use, right? So it is capitalize as right of use asset on balance sheet corresponding lease liability. Right? Generally, in operating lease, every time we pay lease rentals, we show it as an expense, expense to cash, and that expense is shown in income statement. Right? We never used to show operating lease in balance sheet, but this is the treatment as per US GAAP, that it cannot be an off balance sheet item. Since we are recording the present value of lease payment as a liability, so there has to be an asset, and the asset is what? Right to use. So the journal entry for this will be ROU, right of use, asset debit, lease liability credit. So this is what at the rate PV of lease payments to be made. This is what at the rate present value of lease payments to be made, right? Now, what about asset? It is lease liability plus any payments that I might have made before the lease term or any down payment that might have paid today, right? Plus any payment made at or before commencement, right? So it will be ROU debit, lease liability credit, cash credit. Yes or no? Plus initial direct cost incurred by the lessee less lease incentives. So when I debit asset, it will not be only with lease liability. It will be with plus any payment which I have made today or initial direct cost which I have incurred less any incentive which I have received. So this is basically about ROU, right to use asset, right? This is about right to use asset. Is it fine, everyone? Now, after commencement date, there are two entries that I have to pass. Means every time a lease payment is due, after commencement date, what will happen? Lease liability debit, cash credit, isn't it? So whenever I'm making payment, this present value is, this lease liability is getting reduced, isn't it? Huh? Record payment of lease as a reduction of liability. Right? Then what are we going to do? Lease expense debit, and here we will follow SLM. Remember, here we will follow SLM. Right? ROU credit lease liability credit. So basically this is the plug, the balancing figure. I'll show you with the help of an example, no problem. In case of operating lease, the lease expense over the year is same. Right? The amount of lease expense that I will show over the year, it is same. Hmm. Because initially I have treated it as an asset. Slowly, I will show it as an expense, right? Now I will show you an example so that you can get things in a much easier way, right? Let me just show you an example. On 1st Jan, year 1, lessee leases equipment for 3 years at the rate $25,000 payable at the end of each year. Payable at the end of each year. Right? Asset life is 10 years. So by default, I can easily make out that this is not a finance lease. Because after 3 years, lessor will give it to someone else. I'm not using the major life of the asset. If I was using the major life of the asset, then by default it will be a finance lease. It is one of the criteria. Right? Implicit rate they have given us 10%. If this rate is not given, then we will go for what? If this rate is not given, we will go for lessee's incremental borrowing rate, right? Now tell me one thing. One treatment can be very simple. Year 1, right? Year 2, year 3. This is one type of treatment. What is the treatment? Simple. Lease expense debit, cash credit. How much? 25,000. 25,000. Right? This same entry will be repeated year 2. This same entry will be repeated year 3. Is it fine? This is one treatment. Lease expense cash, lease expense cash, lease expense cash. Normal, like we pay salary, we can show like this. But what US GAAP is saying? US GAAP is saying no, you will record present value of lease payment as a liability. So automatically there has to be some debit. So the above treatment is not prescribed. Right? So now what is happening? The operating lease is being treated in a different way. Right? So first of all, this is year 1, 2, 3. We have lease payments. How much? This is what we have to make. Now PVIF at the rate 10% equal to 1 divided by 1.1 equal to 1 divided by 1.1 power square equal to 1 divided by 1.1 power cube. These are present value, right? We have done this when we have talked about in case of bonds, Discount amortization, we have spoken about this thing, no problem. Then PV. So simply multiply this into this. Copy. Right? Equal to sum. So this is the present value. Right? So let us do one thing. Just right. So this is what present value of lease payment. So on 1st January, year 1, ROU asset debit, lease liability credit, 62171, 62171. Right? Is it fine? Shall we move ahead? Now we need to prepare amortization schedule. Year 1, 2, 3. Lease liability 62 171. Right? Then interest at the rate 10% on this lease liability. Suppose if this is my loan, then on this 10% I have anyway I have to pay interest. So it is coming to 6217. So it means actual payment that I am making is 25. Huh? Yes or no? So out of 25, if this much is interest, so this will be plug for ROU. It means from 25, this much is interest. So this is the plug for ROU. And what is closing balance of lease liability? Tell me. It will be this plus interest. Yes or no? Minus this. is normal loan. During the year interest is added and amount paid is subtracted. So next year we have 43388, 4339. This is 25 only. Control B. Control B. So next year it is what? 22727. 2273. This plug is depreciation sort of. Out of this much payment, this much is interest. So remaining is depreciation. December 31 year 1. First entry is what? Lease liability debit, cash credit. How much? 25. 25. Then lease expense debit how much? 25. Yes or no? How we get this 25, you know? No. This total is how much? 75 divided by 3, I got 25 because SLM. This is 75,000 divided by 3. Right? So we have lease liability how much? The interest part. 6217. And then you have ROU credit. The plug. How much is the plug? 18783. Year to this plug will be different. So this will be how much? 4339, and this one will be how much? 20661. Is it fine? So this is how amortization is done. Is it okay? So this right of use closing balance will also be same as lease liability, except for these. Suppose if there is any direct cost or is there any incentive which is amortized over the lease term, in that case it might be different. Otherwise, ROU asset and lease liability is the same balance. You just see from 62,171 which was ROU asset minus this plug, you will get 43388 itself, right? So closing balance of ROU asset is equal to closing balance of lease liability. Adjusted for the following. What are the adjustments that we have to make? Prepaid or accrued lease payments. There might be some lease payment that I have made in advance. Remaining unpaid amortized balance of incentive or direct cost and impairment if any, because impairment we do for assets, not for liabilities, right? Wherever you find any asset, you will need to test it for impairment, right? Now let me take another example, right? So entire stuffs are okay, right? Let me just copy this. This is another example. Now out here the point is it is 20,000. It is 20,000 at the end of Y1, 25,000 at Y2, 30,000 at Y3. Right? So when I take this present values, so this is 20, 25, 30. Right? So 20, 25, 30. 20, 25, 30. Right? Done? Now here you can see one thing. The total of this is 75. It means legal expenses will be 25 each. But first year you paid how much? 20. It means 5,000 is outstanding. Isn't it? So in this case, the balance of ROU and lease liability will not be the same. So this entry is okay. We have got the present values. So here it will be 61382. Interest will be 6138. This is 25, the expense part. Lease expense which I am showing. This is expense. So we cannot call it as actual payment. Is it fine? Hmm? Here expense and payment is same, no problem in the previous example. Can you see here? This is lease expense equals to SLM. Right? But in this case, lease expense is something different and payment is something different. So when you calculate plug, we take 25. But this closing balance is wrong. Original amount plus interest is okay. But how much we have paid? We have paid 20,000. So this is the closing balance of first year. Expense is different. Payment is different. So we have 5,000 outstanding because expense is more. That is why liability is more. Okay. Let me just complete this. Then I'll come to you. So this is 47520. So this will be 4752. Again, next year expense is 25. It is SLM. But when I take closing lease liability, this year how much I paid? 25. So it is 27,272. 27,272. So this will be 2727. Or 2728 you take, round off. Right? This closing will be this minus this. Lastly, we have making payment 30,000. It is 0. So here ROU, when you take plug of ROU, we compare interest expense and lease expense. But when you calculate lease liability, we take the actual payment that we have made. 20, 25, 30. So here ROU balance will change. I'll just show you ROU balance. I'll just show you, wait. So this year one payment is 20,000. This payment is also 20,000. This payment is okay. And finally we will make 30,000. We will make 30,000. Legal expenses okay, 25 each year. Interest expenses 6138. Plug is 18862. Interest expenses 4752. Plug is 20248. Interest is 2728. Plug is 22272. So we have ROU in the very first year. It is 61,382 minus 18862. So this will be 42,520. See, this ROU is 5,000 less than the lease liability. Why? Because 5,000 is outstanding. Expense is 25, but I have paid only 20. $42,520 minus 20248. How much? 222,272. Now what is the lease liability? 27,000. Here it is 22,000. Again 5,000 because difference of first year. There is no difference in second year because in second year it is 25. The difference of first year is still carry forward. And last year it is 22272 minus write off is 22272. So that is 0. When you take plug for ROE, you compare with lease expense. But when you calculate lease liability, so you will take payments. So we will have a difference between your ROU and lease liability here. Okay. So that's it from today. In the next session, we will start with finance lease. Okay. Bye bye.